All right, Sunil, it's 11, so we'll let others join in. We already see a lot of people have joined, so we'll just get started.
Yeah, sure.
Okay, all right. Good morning, everyone. Welcome back to another one of our Saturday sessions with Asset Plus Academy on mutual fund distribution. Thank you for joining on a Saturday morning. It's always encouraging to see such active participation from this community. Once again, we have with us someone who truly needs no introduction, Mr. Sunil Subramaniam. He comes with over 40 years of experience. That's practically the entire history of mutual fund in India. His perspective is something very few people in this country can offer. I have previously he has I'm so sorry. He has previously served as the managing director at Sundaram AMC, and today we are proud to have him as the strategic advisor for MFD growth at Asset Plus Academy. Today, we will be learning from him about the psychology of Indian investors. So, yeah, today's topic would be about the psychology of Indian investors. This is a very crucial aspect for MFDs to understand because beyond products, processes, and regulations, it's what investors' behavior truly shapes the long-term outcomes. So, why investors react the way they do, what influences their behavior, their decisions, how emotions impact their decisions, all of this. These are insights that can transform the way you guide your clients. And of course, no one can explain that better than Mr. Sunil. So let's dive straight in and make the most of this session. If in case you have any questions, just drop them in the chat box. We see that a lot of people are raising their hands. You can drop your questions in the chat box. We will be taking them toward the end of the session. All right. Let's start, Sunil, then.
Sure. Thank you, Sukanya.
Yeah.
And good morning to all of you. Welcome to another Saturday School. Each time, peeling the layers of an onion, we are trying to uncover different things which will help you make a successful MFD career, right? So this is targeted not only at new aspiring MFDs, but even existing MFDs can very well benefit from the kind of aspects that we are trying to uncover in the course of your journey. So today is going to be, like Sukanya mentioned, about the behavioral aspect of investors, right? And it's important that we understand the psychology behind why investors are choosing. Because first of all, as a mutual fund distributor, right, SEBI's guidelines allows you to sell mutual funds only, right? So to that extent, that is in the listed capital market. That is whatever SEBI guidelines cover. So obviously, insurance and those which are outside the purview are different. But the key is that mutual funds itself as a product are competing against a whole bunch of asset classes in the customer's mind. Now, as far as India is concerned, we know we've crossed 77 lakh crores, and this is the fastest growing industry probably in the country, apart from some e-commerce ventures. So, if that's the case, right, if people seem to be buying mutual funds very rapidly because the number has gone from about 3 crore unique investors around COVID to now about 5.5 crores. So, if there is such a rapid growth, almost a 60% increase in the investor base, then why should we bother understanding the psychology of investors could be a question. Well, the question lies in the fact that when the glass is filling up rapidly, it's barely half full. It's only a quarter full. India's average mutual fund penetration is still a quarter of the world average. So, which means that about 17% of GDP in the world is about 73% of GDP is the average. So, clearly, from a amount of money perspective itself, we have a long way to go. Second, I mentioned this 5.5 crore individual PANs in the mutual fund industry. You're all aware that our population is 140 crore. So clearly, there also we are barely scratching the surface in terms. So clearly, then from an investment perspective, mutual funds are one product, but has not made a big dent yet into an investor's mindset. Now, when you use the word investor, it is in a very loose frame. Please remember that. An investor is a person who's allocating his money for the future. Now, people who put their money into savings accounts and FDs are also investors because they are also putting it with an intention for the future. We tend to call that savings and this investments because the perception is that savings are risk-free, whereas investments carry risk and reward that goes with it. So the first thing is that we've got to understand where customers are putting their money and why they are doing that. That's one, because clearly only 5.5 crore people are putting it here. The second aspect of this is this changing socio-demographic environment of India. What do I mean by that? The demographic dividend, you would have heard of the word. Where does it come from? What it means is that India is today the second youngest country in the world with an average age of 28 years, right? Which means what, in the mix of the population, the youth are taking a larger space. So now when we look at the psychology, it's not just looking at the existing 5.5 crore investors who already come in. It's not looking at the existing 140 crore people who have a bank account, but it's about understanding that is the younger person different from the older person. So first of all, what we'll try and do, we'll try and look at a traditional investor, and second, we'll try and look at a enabling investor. And there, one key point which I want to mention here, we'll come into numbers later, but is the fact that demat accounts are 2.5 times the number of mutual fund individual unique folios. It's about 12.5 crore demat accounts versus, so clearly, and this is again a post-COVID rapid phenomenon, right? So keep that in mind. Why I'm saying this is that post-COVID itself, there's been a dramatic change in the mindset of the potential investor, right? As you can see, if 2.5 times of people are willing to take the risk of direct equities through demat accounts, but they're not willing to yet trust mutual funds, clearly there's an element of trust that comes in, but also there's a recognition there is one segment of the population which is actually comfortable with risk. So historically, the reason given for low penetration of mutual funds was that people are scared of equities, scared of the risk and the safety of fixed deposits. We'll come into that in subsequent slides, but I want to, at the macro level itself, tell you that you have to look at the young investor versus the legacy investor. You also have to look at the risk appetite of that investor. Now, it's not that you can bracket all young people into risk takers and all old people into conservative people. No. So clearly, then you need to look at, but in today's session, I'm going to broadly bucket this into a legacy mindset and a new age mindset, right? And when you then meet a potential investor or you already have an existing investor, you need to broadly bucket them into this. Now, when I say legacy mindset, right, it could be that a conservative man's son is also carrying the same conservative in him. So don't just put this by age, but try to look at the mindset of people. A young person could very well have a legacy mindset, whereas an older person willing to take risks could have a new age mindset in terms of experimenting with newer things. So we are talking about mindsets. Broadly, there is a correlation with age, but it's not necessary that old people are conservative, young people are risky. Okay. So we are going to talk about mindset. So legacy mindset versus this, right? Now, one more factor I want to talk to you all before we get into this is that we have to understand our nation, right? India has the largest population in the world. At one point of time in our history, we were the largest country in the world in GDP. We are today at the fourth rank and maybe targeting in the next 3 to 4 years to become the third rank. The second rank and the first rank to occupied by US China will take some time. Why I'm pointing this out here is that despite having 20% of the world's population and being the largest country, as a country, we are defined by certain cultures, certain values, and certain behavioral patterns, right? What is that due to? Is we need to understand before we step into a slide. The first thing to understand is that India is a country which has been subject to two things consistently through its history. One is the vagaries of the monsoon. We are a very agriculture dependent, but we have only a few perennial rivers like the Ganga and the Krishna and the Godavari. Most of the rivers are rain fed, and we hence our lives are dependent on the weather god. If there's a good monsoon, there's plentiful abundance. If there are years of drought, there's the, that has culturally affected the Indian ability to take risk because we are always preparing for a bad day of a drought. Hence, we want to store. We store the rice grains in the good harvest so that the next year, if it doesn't come through, we are able to manage through that. So that's one mindset, that the volatility of the weather is something that's occupied a mindset, and hence a tendency towards safety and assuredness. So wherever you find a assuredness or a safety, there is an Indian mentality that takes it. The second thing which has impacted the same, the behavior response is the same, is the repeated invasions our country has faced. And this is culturally passed through our DNA. It's not something you'll say, oh, no, I'm not scared. Who's this? This is a new India. All that is fine. What we need to understand is that culturally we are driven by that need for safety and security. And hence, right, some of the things now about the legacy mindset, you can now understand from this broad basic I've given you. So if you can move to the next slide here, right, to understand the key aspect which Indian investors look for. Sugandhya, it's possible to share screen?
Yes, I'm just sharing the screen. I hope the presentation is visible.
Yes.
Yes.
So we can go down to the next slide. This is okay. Let me leave it at here. So, like I said, what you can just go back to the previous one for just a second.
Sure.
Sugandhya.
Sure.
Okay. So basically, the subtext is what I want you to read. It is that what we are trying to do today in this session is understand the habits. The habits are what? That which are consistently repeated. Biases, which means how do you look at it? You would all have seen, if you have read some books, some pictures, right, where a person, there's a drawing and a sketch of a person, I would say. On one angle, if somebody tells you this is a young girl, it looks like a young girl. But before you see the picture, somebody tells you, I'm going to show you the picture of an old woman. That picture looks like an old woman. So these biases from where we come from, right? It's not, there is no objectivity in life. Everybody has a subjective approach to what they see. So one man's meat is another man's poison is a very crude way to put it. But we must understand the biases with which we look, the lens through which we look. And of course, the third, of course, is what we said, the shifting mindset from the legacy mindset to the new age mindset. These are the things we're going to cover today. So we now can move to the next slide. Right. So what I was trying to hint at was that the Indian investors are driven by feelings of safety, pride, and trust, and can relate it to the things that I said about our country's cultural history, how we have been. And hence, when you crudely think about it, is that everybody has a left side of his brain and a right side of his brain. Okay. The left side of the brain, which controls your right hand body, your right arms, is generally a what is known as a rational thinking, critical analysis, treating numbers, saying no, if this returns shows this way, this is good, right? That's the left brain thinking. The right brain thinking, which works through the left. So you see, left-handed people, for example, are more artistic, more nuanced, more feel rather than this. So in India, right? While we cannot say that everyone in the population is a right brain person, but generally we are right brain people. There are left brain. We've had mathematicians like Ramanujan who have been world class in that. No questions about fragmenting the competition. But when it comes from an investor's perspective, you got to remember that you have to cater to both sides. And sometimes what happens is that is the right brain activity, which is feelings, as opposed to logic and rational, which is left brain activity, which dominates. So why I'm saying this, as a mutual fund distributor, especially those existing MFDs who are on this call will know very well that a standard approach is to go and take past returns and show the numbers to convince people. Well, it succeeds, but the key point is that that doesn't hold the investor back. Numbers are a good way, perhaps, to invite them into the investment fold, into a particular product, particular strategy, show the past returns. It has a value. But keeping that investor through the volatility, which is inevitable in the equity markets, is comes from your catering to the right brain thought processes, which are feelings. And what are the feelings I mentioned? I said the need for safety. the feeling for pride, and the feeling of trust. So these have to be in tow with numbers. We are in a numbers driven industry. There are returns, and you can't avoid talking about those numbers. Don't get me wrong here. But it has to be layered, because the customer, especially when there's a tough time, when the returns are not there, it is this feeling that, oh, is my money safe with this person in what he's done with it? Is there something that I can trust with him? Right? So please bear in mind that aspect, that we need to cater to both left brain and right brain of an investor. And we tend to ignore the right brain very often and simply lead with the numbers. So just one caution there on that. And then we can now go to the next slide, where because of this kind of a behavior, the legacy mindset is rooted in security. So assessing your investor, existing or new, the first thing is try to identify what is his mindset. And like I said, age has a limited only element to do with it, right? It could be young people have a legacy mindset and old people don't have a legacy mindset. But the legacy mindset people, what do they typically reflect and show you? A deep attachment to physical assets, gold, land, house. Today, just gold plus real estate accounts for 67% of the assets held by households. 67% is in gold. And in fact, that number, I suspect, would have gone up even more, given that gold has rallied 50% the last 1 year. So if you look at what they're holding, who knows, the 67 could have crossed 70 today just because of gold's appreciation. Not that, and people are buying more gold. You saw yesterday, if somebody you are tracking economics, you can see that trade deficit has widened because Indians have been importing more gold. So it's not that it's ending anytime soon. So this deep attachment to physical assets comes from that mindset rooted in security. The second aspect, when you come to financial assets, which is the balance 33%, in that also 60% are in low return bank deposit savings accounts, is what the data shows. Which means what? What are they? They are the assured return products. I'm better to be safe than be sorry. So the second aspect is a physical, then whatever is left which goes to financial also, they give a preference to assured returns. And then on top of this is the fact of the human touch, wanting someone to be guide and to be accountable. Why I'm saying this is that if you go that, you can say, like historically, for example, the post office. Post office savings was the most popular. It is continues to be very popular, but it used to be very much more popular before this Jan Dhan Yojana started and a lot of people shifted to regular banking accounts. Our country. And if you remember, the post office money was collected by the post office agent. There used to be an agent who used to come to your house. There was a trust in that person that he's taking your money. Yes, he's putting into the government of India. He's not going to run away, but he's there to provide me service. When I need the money or whatever, if I want, he's there at the beck and call. And even the early banking system in India had a scheme called the Janata Deposit Scheme to take ordinary people's money. And there used to be Janata Deposit collectors who would go street to street and he would be your primary contact. I'm talking about the old days. I'm just bringing this out to say that a lot of people put the money not just because of the assured returns, but also because there was a trust in the provider of that service, right? So these three are the legacy mindset which you should be carefully aware of. Why I'm pointing this out is that when then you deal with an investor, if you're only going to tell him that, oh, physical assets are bad. I mean, today is a bad time to say that about gold. But historically, we all know that, and the industry, we have always beaten down gold as an asset class. We're beating down real estate as an asset class and say, no, no, equities and mutual funds are the best. We have the best capacity to beat inflation. There's earnings growth. India is the fastest growing country. You all remember that despite these years of attempts by the mutual fund industry, and AMFI has done this huge campaign called Mutual Fund Sahi Hai. Where are we? We are still at only 5.5 crore individual PANs. So my suggestion to you is when you go and meet a prospective investor, don't go and beat down these competing products. You have to have some basic knowledge about those products. Take him along. Tell him I will be your guide for all of your assets. I will get help for you in everything. And over a gradual period of time, you can wean him away from the full security that he feels in a property into going in. And there are step paths which the mutual fund industry is created. For example, in gold, we have gold ETFs. Yes, they don't give you much in terms of revenue in commissions, but they are a financial way of holding gold. And there are multi-asset allocation funds. So you can tackle that need for gold also by talking about multi-asset allocation funds, which puts money, a part of it, in gold. Similarly, REITs as an asset class is growing very, very fast. So that's again what? It is a paper way of holding real estate, which is takes you away from the location. If somebody wants to buy a property, it's got to be in his city. Rarely people go to saying, oh, I buy a property in another city. But in this, through REITs, you can own properties. And if you believe that properties are good for you, REITs give you a wonderful way to own property anywhere in India. It gives you an ability to own commercial real estate, which a normal human being, normal individual can't do so easily. So what I'm trying to say is, when you talk to the customer, you have to talk. And let's come to the bank deposit, assured returns. Now, yes, you have to talk to him about his bank deposits. You may not make any commission on that, but you can also look at offering him private company fixed deposit where you get some amount of commissions, because they are also there of good quality companies where there is a reasonable assurance of safety from the perspective of the company, from a AAA rated or a better rated companies. So include that in your discussion. If you do not address his mindset in terms of your product portfolio that you are going to discuss with him, you cannot make. And only then will you build that trust, because he will say he is not here to just take away my property money, my gold money, my bank deposit money into this risky asset class called mutual funds. There is a barrier. When you moment go and then start you pushing a product saying, look, this product has given 23% return per annum over the last 5 years, come. The point is that his mindset is not going to be acceptable for him to take your words at face value, because he says, is there safety in what you're saying? No, answer is no. There's no safety. Is there volatility? Yes. How do you put that across? Only when you first build his trust and confidence by discussing with him about the entire asset class in which he is currently investing. Talk to him, and then when you build that trust over point, you can, based on the risk appetite of the individual, look to transfer some money out into mutual funds, either debt mutual funds or equity mutuals. So this is the summary of the legacy mindset and what it means in the next slide as we proceed. Can we move to the next one? Why this mindset exists? Well, I discussed this in my preamble to today's talk, right? The scarcity driven upbringing. So that fear of loss dominates the joy of gain. And generations have equated wealth with possession, not with cash flow. Right? You have property, you have gold, that's what is wealth. It's not that you invest in asset class which gives you returns. Right? That's a mindset process. And historically, a low trust in institutions. And when you say institutions, don't jump into the banking system or whatever. We mean institutions like chit funds, institutions like blade companies, finance companies, which came and promised multiple times the returns that a bank deposit gave. And these were institutions. You will all know, we don't want to take names here, but we all know that there have been big institutions which have collapsed with people's money, right? And when that has happened, they have then tended to feel that, oh, this big institution is talking numbers, everything, but I don't trust it. I trust the person who's here because I know I can call him anytime. And I know that he will understand my emotions in dealing with me, right? So that's the reason this mindset exists. And the next slide will tell you that what this mindset leads to in terms of emotional triggers. So when you now look at the emotional triggers, right? First of all, loss aversion is stronger than the desire for gains. The question is not how much can I make, is how much can I potentially lose. Okay, so 1 rupee loss is equal to 10 rupee gains, to put it across in a very sharp way, right? And that's why, when you go simply by past performance, point to point past performance, right? You find it very hard to sell when the past performance is bad because it's showing a loss. And you'll find it easy to sell when the past performance is good. But because at that time we are not talking about the loss. What are the answers to this fears of loss? First is that you have to address that fear. You can't avoid that fear. How do you address it? Rolling returns analysis, which tells you when did a fund do well, when did it do badly, when did the market do well, when did the market do badly, and when the market did well, how did this fund perform? When the market did badly, how did this fund perform? That is, did it protect money from the extent of loss that the market suffered? Yes, in that process of protection, it will have to give up some gains. We know there is no reward, risk without reward, right? So when then that fund is protecting, the upside has to be given up. But we scared to talk about that lesser upside when the market is booming, saying this fund delivered only this much. We put ourselves on a back foot and we get an infraday feeling. The important thing is to address the issue to say, yes, the markets have given bad returns in these periods. This fund has not given as bad returns. That's when you will tackle that thing in the box saying, how much can I lose? We are all focused on how much can I make. So if we take a rolling return analysis and focus on the downside protection, that fund, that's the kind of fund we should also be selling. Because when you acquire the customer, you're acquiring customers in good times, it's easy to acquire because the past returns are showing good. But when those bad time comes, how far is that customer's trust going to get destroyed in you unless you have sold a product which can also protect his downside so that you can take it out and show it to him? So at the selling time itself, you have to make sure that you're pitching the product saying this product may not have made the best returns in the market, but it has not made the worst returns in the market when the times were bad. If you make that as your sales pitch right at the beginning, and the customer is also aware, A, you are caring about his losses, B, you're not pitching him just the best performing fund in a good time, you're also pitching him a fund which has performed decently in good time and decently in bad times. That will appeal to that customer much greater, to a person who has a legacy mindset. Don't forget that. So understanding the mindset and then meeting your sales pitch according to that is what this is critical. That's the fear of loss. The second aspect we talk about is pride. Like they have this tangible assets provide psychological comforts. Owning gold or property feels more real than holding stocks or mutual funds. So that's why I say that you can't go and say, sir, make your property zero, make your gold zero, they're bad. No, you have to talk to him in a knowledgeable, intelligent way about the property markets, about gold and its future. Today, information is not at a premium. You are getting information from a whole bunch of sources on all of these asset classes. So it's up to you to be prepared to talk to him about tangible assets, guide him on tangible assets. Yes, there's no harm in actually being advising him on a group property to buy, because you're not just trying to say property is better than my mutual fund. No, you are addressing his need, that he has a need to invest, and maybe he wants to book profits from his existing mutual fund investment with you and put that into some property. Go along with him, because if you're not going to address that key need of pride in ownership of physical assets, you're going to lose the trust over a period of time. Then he'll never talk to you about it. He'll tell you some reason to redeem it, and then he will go and quietly buy that property. But once it goes into that black box which is outside of your control, then you are in a downward spiral, because then you are not in control. So take control of his entire investment portfolio, which are catering to different needs in him. All of this is about the legacy mindset person. The third, of course, is the social validation. Log kya kahenge? It's important for him, right, from his thing. So to that extent, in your pitching to him, you've got to be aware of this. That you can't do anything about a social what does people think or whatever. But it where it can make a difference, I'll tell you, is, let's say your customer is a man and you have kept track of the family's birthdays. Now, if you have taken on his wife's birthday, and on his wife's birthday, you have engineered a redemption a week before the birthday to enable him to buy a gift for his wife. He may not have even remembered his wife's birthday, right? As on a lighter vein, but you have done it for him. It's that social validation, because in his wife's eyes, wife is also part of his social circle, right? He goes up in his esteem. And then this product that you are catering to him has helped him improve his social esteem. Similarly, children's birthday. If you can redeem a small amount of it, give it to him and say, it's your daughter or son's birthday. Please use this to hold a party. Imagine the validation. And who will, he will tell them, look, he will invite you to that party and he will say, this man only actually, from my profit book, he booked it and he has made this party. So the social validation, you can play a part in multiple ways. I just pointed out one of them here, right? So from these emotional triggers, right, now let's move to the new age legacy, not legacy, new age legacy, the new age investor. What is this new age investor? This new age investor is going to be completely different. These are the new demat account holders, the new direct equity participants, the margin traders, the F&O option people, all that you read about, right? And the people who are targeted by the finfluencers of the world. What is this new age investor? He's not afraid of small losses. He's more afraid of the next big win. So he doesn't carry any of this cultural mindset hangover. These they are not from the agricultural background, so it doesn't matter whether there was a drought or a monsoon. He is not aware. For all all he knows is that we have beaten Pakistan in every war since the last few decades, right? So we are not like being invaded now. So these people don't carry a much of legacy. This new age generation, right? They are obviously willing to take the risk. So the next slide will then talk about this evolution from the legacy investor to this new age investor. What's happening to the legacy investor? We just to summarize what we just spoke about. There's gold, there's real estate, there's FTs, safety. Trusted family advisors, long-term saver mindset, seek security above all, risks tries to avoid. Trust is more important than tech for him. Yes, all this processing, fast, quick through, straight through investing, KYC, and Jiffy, all of that is good enablers. But for him, the trust dominates the tech. Whereas the new age investor, for him, stocks, crypto, and mutual funds, maybe the sectoral mutual funds, the defense ones, the new age ones, the IPO based funds, right? So these are smart for them. So safe as opposed to being smart. These people, because they're exposed to the knowledge revolution, right? The penetration of the internet, the availability of the markets worldwide. There are enough influencers there dumping them with information. So knowledge is there at the drop of a hat, right? No, why have you changed slides?
No. So sorry, apologies.
Okay. So who does he rely on for this? Well, YouTube. First thing is YouTube is the source for all information. There used to be Google, but I think YouTube, because of the video part of it, is now much more thing. And of course, the fin influencers who have massive followings, as all of you know, right? And they have a mentality of a short-term trader. Why? That quick win. We'll dwell into this a little more later, right? And what he seeks, excitement. They want excitement. And so they're willing to experiment with risk boldly. And of course, for him, if it's not, you bring a paper to him, you've shut him off from your life. He's all online. For him, tech is enabling the trust. So you should be on top of the whole tech thing with him. Otherwise, he's going to say, "Hey, you're an old age person. You're not going to fit my mindset." And so he will not have a trust in you. Right? So this is the thing. So what does this new age mean? To summarize the new age into the next slide, as we move in, there's only one or two words, right? Instant gratification. We all know about the buy now, pay later, EMI revolution that's happened, right? Whether it's a holiday which you do through credit card EMIs, whether it's a car that you buy through EMIs, or housing loan through EMIs, EMIs have taken us over. It's all about what I want this product today. I'll pay for it later. The legacy mindset was almost opposite. I'll build up and I'll use my provident fund balance at the end of my career to buy that house that I want to live in. That change in mindset, that instant gratification. So what that first block tells you is that it's results now, not in 10 years. They want to see their portfolio growth immediately. So here you recommend a product and next month it goes down, he's going to be very unhappy. He wants that. Okay? Little patience for this long-term compounding. You will try to change that obviously as his advisor distributor, but this is where he comes from. And social media has shortened his patience because influencers showcase overnight success stories. You would have seen that influencer, I think it was in Pune, right? Who used to dance. So he goes around the screen showing the returns and make everybody dance and enjoy and see. So they are making traditional investment feel painfully slow, right? Nobody wants to plant a seed, watch it grow into a plant and then to a tree, and then it will give fruits, and then we'll enjoy the fruits of that. No, they want to go and buy that fruit today itself, immediately, right? So naturally for them, SIPs are feeling too slow because it's boring compared to the thrill of active trading and quick profits. So what you go and pitch to this new age to only understand their mindset. So then we delve further into this new age portfolio. The next slide, right? The BNPL, what is that? Buy now, pay later. And YOLO, all of you know, you only live once. मैश करो, enjoy life while it's happening. दोबारा जिंदगी तो जीना वाला नहीं, right? So this mindset is what? Invest now, think later. Buy now, pay later extends to investing also. बाद में देखा जाए, invest now, think later. Next, no fear of debt. Parents were very debt averse. They used to worry about borrowing at all. Until that card is prepaid, they will have sleepless nights. They'll try to go and prepay, do it. No, this generation is comfortable. And the word debt we're using, they view debt not as debt, they view it as leverage. The word leverage means what? You heard about the story about, I think it was Aristotle or Archimedes, one of the Greek philosophers. He said, give me a long enough rope or long enough rod. I'm sitting here, I can move the moon, right? That's leverage. That you do a small bit of the move, the log is wrong enough, you can even move the moon. So this margin trading and leverage, they don't trigger caution. All he looks at is the super gain, right? You know, in margin trading, you put in 20% and borrow 80%. You make 1% return on your overall portfolio. You made 4% return on your 20%. Of course, the knife cuts both ways. When you make a loss of 1%, it's amplified as the loss in your portfolio. But they don't worry about it. They only look at the greed element and have a very low fear of debt, willing to borrowing to invest and money. And second is the next point is experience over delay. This is what is instant gratification, right? They don't want to delay their gratification. They want, let me enjoy it. Let me learn. I don't mind making mistakes. Let me learn it and enjoy it rather than be patient and wait and wait and wait. So this is the mindset of the new age investor. And naturally, with this thing, what has happened? The next slide will tell you that it's meant that it's the rise of the risk takers within the new age mindset. What is it? The experimental spirit. Something new doesn't scare them. But the legacy mindset, something new is not to be touched. Whereas here, the willingness to try crypto, to options, to small cases, which the previous generation would never touch. They are open now. Why I'm saying this is, as a mutual fund distributor, it means that you have to get a basic knowledge of these things, because in the conversation with you, he is going to bring it up. And if you're just going to beat it down, say, no, sir, it's too risky, don't do it. No, mutual funds are safer. No, you lost the customer right in the first conversation. Mentally, you have lost him. He may continue the conversation with him. He'll give you some little bit of money to invest. It's not that. But mentally, you have lost it in terms of getting to him, address to him. So why I'm saying this is, you may not be dealing with crypto funds or options or small cases, but you have to know about it to have a conversation, because then only you build trust. Because then you talk at a meaningful level to him about the things that he is keen to experiment on. Next is the view and approach to risk. Risk for this new age mindset is an adventure. It's an exciting journey and it's an opportunity, not something danger to avoid. It's like going on a holiday and doing that skydiving, bungee jumping, right? The new age mentality is let me try it. It's something new. It looks exciting. Paragliding, right? So all of those things. So risk is an adventure which they are willing to take on. And secondly, just as we saw social validation in the legacy mindset, that's peer validation. Because his friends, his colleagues, they are all taking risk. He doesn't want to be going back. So the success stories from the friends and the social media influencers creates a powerful what FOMO. What is that? Fear of missing out, and encourages his bold moves. Right. So this mindset you got to understand that they are not running away from risk. They're willing to risk. What's your role? Your role is to point out the reward risk equation to these people so that they can spread their risk into different kinds of risk reward equations. So that's where it's the approach, selling approach itself is different. And so this risk takers, it leads now to classically this investor, the new investor in the next slide, can be labeled as the quick gun Murugan. You heard about that comic strip, right? The quick gun Murugan, who wants to take out the gun and fire immediately. What's happened? The trading apps that they go into make it very easy to exit because of technology and everything. They can say, oh, I made double my money, I want to quit. If you had stayed, it may not be doubling again, but even a 50% more return would have made much more money. No. But because of the effortlessness of that tech, it they are prone to making impulsive decisions during volatile times, right? So that's what you need to be aware of. So even if they give you money into a mutual fund, you need to have the answers ready to his hot button thinking. Okay, that's number one. Second, momentum over compounding. What's चल रहा है उसी में पैसा डालना है, right? Chalti ka naam gadi. No, they say, right? So chasing hot stocks trends replaces the patient power. Now you can't go and try to talk about this patience. You're going to lose him. You have to address his momentum and gradually maybe do a 80-20. Then you go to 70-30 in terms of what he does towards this. That's your job over a period of time once you have built the trust. And third, of course, is that the appeal, right? The dopamine. Dopamine is that chemical, right? Which gives you a rush, right? So that short-term training gives you that excitement. Typical gamblers who get. And so the quiet discipline required for sustainableness, they have to be taught this in a slow and steady manner by you. But you got to be prepared to discuss this whole excitement and stuff. So your knowledge, general knowledge level has to improve because you need to have the conversations along the same wavelength of that investor and then get him into your long-term compounding, SIP, patient investing, waiting, all of that over a period of time, right? So this quick gun Morgan investor is largely a trader, you can say. So maybe it's not even right to call him investor, but there are people who are in this new age generation also looking at investment. But what's different is that, if you can go to the next slide, is that these people who are actually investing for a future, can I have the next slide? Yes, they are changing from bank FDs to equities to F&O and crypto. Yes, that's what is happening. But they also have a fire dream. What is the fire? It's financial investing to retire early. They all say, look, मेरे डैड की तरह इनको 60 साल तक मेरे को मेहनत करना नहीं है. I want to enjoy my life. Means I want to make enough money by 40 ताकि मुझे काम नहीं करना पड़े and I sit and enjoy. ऐश और आराम उसके बाद. But what is your role here? Yes, you got to recognize that. You got to go along with him. But you also got to make him realize what? That he himself is ignoring the longevity risk. And when you can't do this in your first conversation. But why? Because he might exhaust his corpus. What? Because he's looking at his parents' age at 60. But today, the average age of the average Indian, the life expectancy is 72 years. And this is for the entire population. So it includes people on the lower strata or the thing who may not have the access to the hospital facilities and all that a middle class and upper middle class and rich have. And so their lives, so they would argue that an average middle class and above person would live to 80. If he wants to retire at 40 and he's going to start investing at 25, this means he's invested for 15 years and that money has to last him for 40 years. So there's a big risk that he will not estimate the damage that inflation can do in the post 40. He feels that his corpus, he may compute his corpus and say 10 crores will be now, 15 crores will be now, 20 crores. But it's up to you to demonstrate that as inflation rises over the next 4 decades after 40, how is his money going to be invested? So that's where you got to make sure that when he says retire at 40, you have to compensate for the rise in inflation post 40. So the corpus has to be adjusted upwards accordingly, right? So these are the things where you can add value to his whole fire thought process. You can't change the thought process of fire, right? They have that, but you can modify it, you can bring more stability to it and more patience to it, right? And of course, that obviously comes because those people are overconfident in their returns and underestimating the expenses, which is exactly what we spoke about, the effect of inflation on his expenses and this, right? So that's where, right, you in dealing with this new age, you have to deal with one is the trader mindset, but second is the fire mindset. Both of these will be there in the customer base that you target, right? So having now defined both the types, right? Like I said, it's not age dependent. So don't just rush into an old man, his old legacy, and a new age, right? You still have to go through the discipline of assessing the risk tolerance of this investor of yours. Legacy mindset or new age mindset. So how can you do it? Banks and others have very sophisticated models and questionnaires where they classify you conservative, aggressive, and all. Those are all for those institutions. But as an individual FFD, I can say that you can just ask 3 questions to that investor. Maybe you need to ask these 3 questions over and over again, but then in your mind, you got to form that perception of the investor so that your selling approach will be modified according to whether he's more legacy oriented or he is more new age mindset oriented. So those 3 test questions are there in the next slide. For the first one, asking him, have you checked your portfolio more than 3 times this week? Right? The quick gun Murugan would have checked it 6 times every day of the week. The legacy would have said, oh, acha, aapke paas de diya hai paisa, theek hai, rehne do. Right? So that's one way to judge legacy, but also in the legacy mindset, right? Like I said, don't mix it up with age. So that's one thumbs up towards being a legacy mindset person. Second, the question, would you prefer a guaranteed 6% return or a chance at 12% with ups and downs? Legacy will say 1, new age will say 2, right? So that's another way, simple test for that. The third question you ask is, when the markets fall. Now, all these questions don't need to ask them, okay? Assess them. If he calls and says, where is my NAV today, you'll know. This, and in a casual conversation, you say, this is this option, 6% guaranteed, whatever RBI bond or some bank deposit, or this, you can judge it. The third one, when he's your investor, when markets fall, what's your first emotion? Dar, yeah, opportunity. Does he say, oh God, market correct ho gaya? Or does he say, oh God, market correct ho gaya? Or can I put more money in? So that will give you a clear sense of where along that. And mind you, it's while we are trying to simplify it and say, these are not buckets. These are a gradient. These are a gradual. So there's a legacy mindset at one end and a new age mindset at the other. People will be there on various parts of the curve. Don't draw a sharp line and say, yeah, legacy hua, ye hua. But I'm saying the investor, where he is on that curve, on one side is legacy, one side is new age mindset. Where he is on the curve. Somebody could be 60-40, somebody 80-20, somebody could be 100-0, right? So that's what you need to assess so that your sales pitch the kind of conversations you have, the kind of products you offer, all of them will be dependent on the psychology of that investor, right? So based on these things, you try to point out certain personas, which is a fake person, just a profile of this, right? So what we are saying, since I mentioned that it's a continuum, right? Your legacy mindset person can be called as a cautious collector, right? Prefers FDs, gold, real estate, trust safety over returns, better safe than sorry. Then you have the confident clicker. Who's that? Trades on daily apps, trades daily, loves the thrill more, and his mindset is I can double this next month. This is the confident clicker. And then you came to the curious converter, which is the ideal spot where you want to move your investor either from a cautious collector or a confident clicker. Generally, the journey is from cautious to confident to curious converter. But what are this curious converter? He started for excitement, the new age guy, but now he seeks discipline and long term growth. So, learning to stay invested is harder than learning to invest. That is a very important line for you to remember. Learning to study is to avoid the quick gun Murgan things. Learning to stay invested is far harder than learning to invest itself, right? So, what then this means is that to the new age investor, next slide, right? In guiding the new age investor, first thing is that you got to understand the emotion before giving information. I think that point has been made very clear so far. The second is, yes, digital convenience is important, but the human touch is also equally important. And what you're offering, remember, your primary product that you are selling is the trust in you, that you are looking out for him, for his future, for his financial goals, and for everything. And not just those schemes that you are going and pitching. They are just the tools, right? So trust is the main currency that you are dealing with this. So every MFD's job, I would say, is to move investors from the collector to the clicker to the converter, right? So with that, I think we have come to the end of this presentation, and I hope you all enjoyed it. As a quick snapshot, behavioral finance is a large subject. I can talk for 50 hours of it. So, but this is more of what do I say, a 10,000 feet view, just a quick thing that pay importance to the emotions of the investor, understand does he come from a legacy mindset or a new age mindset, and technology is an enabler, not an end in itself. And the key product that you are selling to him is trust. So thank you. And Sunya, if there are any questions, do we have time? We can take a few.
Thank you, Sunil. Thank you so much. That was so much enlightening. Thank you so much. We do have a few questions as I see. So someone has asked, like, which book or blog can be a good source to understand legacy investor and new age investor, if you have any recommendations.
Well, no, this has just come from years of reading, and I don't think there's one particular book or anything which will summarize it. There are lots of good books on investing, but I think there are hundreds of them. So I'll not venture to just pick any one or two and just tell you, because uh, these things are better experienced. I just give you a hint of it. I mean, you can go and search. There are lots of books there, but I'm not particularly going to recommend any one particular book.
Right. A lot of people also someone's asked, like, does CFA helps, or like if they should make any like they're just asking basically if CFA the CFA course will help, or they should just make it big in mutual funds.
No, I would say more than a CFA, I would say a CFP would be helpful. Okay, because the CFA comes from an investment perspective. The CFP comes from a customer solutions perspective, right? Financial products for financial planning, right? Certified. So I would say a CFP is probably better, but it's not absolutely necessary, because I think that, for example, Asset Plus, the academy itself and the parent itself offer a lot of the trainings around these various. I think consistently attending these trainings itself is a good way to stay in touch and to to learn. So these labeled degrees and all, you pass the exam at that time, you cram it, but it's the practical experience and staying updated, right? Which is where I think if you just follow the Asset Plus Academy and this 2 Saturdays a month, we are talking about various aspects. I think consistently listening through this, some of these over a period of time will get repeated, updated. I think would be better. Don't go by a CFA is good for a fund manager and an analyst, but not necessarily from a customer's mindset perspective. The CFA doesn't talk about that at all. It's meant to be, and it's purely, as I said, left brain work. It's not a right brain course at all.
Thank you so much. So another person is asking how to attract NRI investors.
Well, again, I don't think that there's anything separate marketing pitch to an NRI, right? Obviously, they have their money in multiple countries, and as an NRI, he will obviously want to come back and settle down in India, so he'll have a longer term approach towards India. But the mindset of customers, there are NRIs from the legacy mindset, and there are NRIs from the new age mindset. So I don't think that the word NRI itself means anything. Obviously, there's a tax element and everything, so different from NRIs. And NRIs who are looking to come back to settle in India, who have family in India, houses in India, and all of that, are slightly different from those NRIs who will visit India for holidays but don't intend to come back to India at all. So clearly different. But obviously, today India is opening up through Gift City in terms of international investment. So I think knowledge on the Gift City kind of products, both outward bound and inward bound products, and it's important for you because that's a route that increasingly NRIs are going to prefer because of the tax advantages. So that's one. Second is saying you have to, if you're really targeting the NRI and if you want to completely handle him fully, then your knowledge of international has to go up leaps and bounds. Because obviously he might be having advisors outside who are advising him on America, advising on Europe and other emerging markets and all of that. So how far are you in a position to tackle and talk? Because then he'll win his total trust. If you want to only be an India advisor to him, then he is going to decide at some other level about how much to India, and then within India what he does with the money, where you will come into play. So choose your playing ground according to
So we'll just take one final question. This is a good question. So basically, this person's asked, like, most of the investors these days rely on CAs. How can we overcome the thought process of such clients to change the mindset?
left brain, right brain. CA is entirely left brain. CA is all about numbers and accounts and tax benefits and this and that. The trust element of dealing with his future. Yes, the CA will give him tax related advice, right? But apart from that, in terms of financial planning, goal planning, the CA doesn't have the time. CA has got customers like him for whom he's doing his annual accounts, who's doing his tax return filing, who's doing a whole bunch of things. He doesn't have the time to allocate to the emotional aspect of an MFD's relationship with a customer. So I don't see that. In fact, I see many CAs wanting to become MFDs because they realize that just doing that one part, it's a window for him. So a CA becomes an MFD, then he's an MFD, right? So I'm just saying that I don't see that the CA is a threat. In fact, the CAs are they are accounting nerds, right? They are people who have numbers. But like I said, numbers are not the way to go about winning customers' trust. Customers' trust is about talking about the bad times. They're talking about the losses that he can suffer. How do you manage your risk against the reward risk ratio? So, and the emotions, all that I spoke to you over the last 45, 50 minutes, I think is where a dedicated MFD can do a far better job than any pure CA. A CA turned MFD obviously will have a better grasp on his numbers, but he has to have a mindset which is also emotion driven and trust, building a trust, because the customer trusts the CA because he's helping with his tax returns, but that trust is different from the ability to understand the emotions, plan for various life stages in terms of the need for money and the post-retirement planning of that. So I think that MFDs have clear advantage if you become a right MFD, the proper MFD who caters to the emotional aspect and the trust element as much as the numbers aspect in terms of dealing with the customer and his portfolio.
All right. Thank you, Sunil. Thank you for answering all these questions. We don't have any more time to take any more questions. For the next session, we'll keep such questions. Thank you, everyone. Thank you so much for joining in. Next session, we are going to have a live session on how to select mutual funds with Mr. Ashish Sethia. So do join in. Thank you once again, Sunil. We
Thank
hope
you.
to see you on another session. Thank you,
Sure.
everyone.
Thank you.